Preparing for investment banking analyst interviews at William Blair interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work in investment banking, and why William Blair? I want investment banking because it combines rigorous analysis with decisions that materially affect companies. William Blair stands out because its employee-owned model encourages long-term thinking, while its middle-market platform offers meaningful responsibility and close client relationships. I am especially attracted to the firm's strong industry teams and advisory orientation rather than a product-only mindset. I would value learning from senior bankers, contributing to live transactions, and helping management teams make consequential strategic decisions. While answering, connect your interest in analytical work, transaction execution, and client impact to William Blair's employee-owned structure, middle market focus, sector expertise, and reputation for independent advice. Question 2. Walk me through your resume. I would organize my resume around 3 themes: analytical ability, ownership, and interest in businesses. My coursework built a foundation in accounting and valuation, while an internship taught me how to research industries, clean data, and communicate findings under deadlines. In leadership roles, I learned to coordinate different personalities and deliver through ambiguity. Together, those experiences confirmed that I enjoy high-intensity, team-based problem-solving and prepared me to contribute as a banking analyst. Make sure to cover a clear chronological story, explain transitions, emphasize analytical and leadership experiences, quantify results, and connect your background directly to banking readiness and William Blair's collaborative culture. Question 3. Tell me about a company or industry you have been following. I have been following vertical software because recurring revenue, high gross margins, and mission-critical workflows can produce attractive economics. I would assess growth through new customers, retention, pricing, and expansion revenue, while watching implementation costs and customer concentration. The main risks are competition, slower technology spending, and overpaying for growth. I would also compare public trading multiples with recent acquisitions to understand whether strategic buyers are assigning value to distribution, data, or product breadth. In your answer, discuss the business model, key growth drivers, competitive dynamics, relevant financial metrics, major risks, and a recent transaction or development that demonstrates informed commercial judgment. Question 4. What does an investment banker do for a middle market client? An investment banker helps a client evaluate and execute important financial decisions. For a middle market company, that might mean assessing a sale, acquisition, recapitalization, or capital raise. The banker analyzes performance, develops valuation materials, identifies suitable counterparties, manages the process, and supports negotiations. The role also requires judgment and communication because owners may be making a once-in-a-lifetime decision. In that setting, credibility, discretion, and understanding the client's objectives matter as much as technical analysis. Be sure to mention strategic advice, valuation, process management, financial analysis, buyer or investor outreach, negotiation support, execution coordination, and the importance of trust when advising owner-led or closely held companies. Question 5. Walk me through a discounted cash flow valuation. A DCF values a business based on the present value of future unlevered free cash flow. I would forecast revenue, margins, taxes, reinvestment, and working capital, then discount those cash flows using WACC. I would calculate terminal value through a perpetuity growth or exit multiple method, discount it back, and add it to forecast period value to derive enterprise value. After subtracting debt and adding non-operating assets, I reach equity value. Sensitivities show how assumptions affect the conclusion. Make sure to cover unlevered free cash flow, explicit forecast periods, WACC, terminal value, present value, enterprise value, equity value, and sensitivity analysis around assumptions and valuation drivers. Question 6. How do you calculate enterprise value from equity value? Enterprise value represents the value of the operating business available to all capital providers. Starting with equity value, I add total debt, preferred stock, and minority interest when relevant, then subtract cash and cash-like investments. The result allows more comparable analysis across companies with different leverage and cash balances. For example, if equity value is $500 million, debt is $150 million, and cash is $50 million, enterprise value is approximately $600 million before other adjustments. In your answer, distinguish equity value from enterprise value, add debt and preferred stock, include minority interest when appropriate, subtract cash and investments, and explain why the adjustment creates a capital structure neutral measure. Question 7. What is the difference between enterprise value and equity value? Equity value is the value attributable specifically to common shareholders. Enterprise value captures the value of the entire operating business, including claims held by debt and other non-common investors, net of excess cash. Therefore, equity value is typically compared with net income or earnings per share, while enterprise value is compared with EBITDA or revenue. The distinction prevents misleading comparisons when companies have materially different leverage, cash positions, or minority interests. While answering, explain the claims represented by each measure, identify which capital providers are included, connect each value to valuation multiples, and clarify why enterprise value pairs with operating metrics. Question 8. How do the three financial statements link together? Net income begins on the income statement and flows into retained earnings on the balance sheet. On the cash flow statement, net income is adjusted for non-cash items such as depreciation and changes in working capital to calculate operating cash flow. Investing and financing activities then explain other cash movements, with ending cash feeding the balance sheet. The balance sheet must balance because assets equal liabilities plus equity, which provides an important error check. Be sure to mention net income flowing through the income statement, retained earnings and cash flow effects, depreciation and working capital adjustments, balance sheet balancing, and the importance of non-cash items. Question 9. If depreciation increases by $10, what happens to the financial statements? Assuming a 25% tax rate, a $10 increase in depreciation reduces EBIT by $10 and taxes by $2.50, so net income falls by $7.50. On the cash flow statement, depreciation is added back, producing a $2.50 increase in cash because of the tax shield. On the balance sheet, PP&E declines by $10, cash rises by $2.50, and retained earnings fall by $7.50. Assets and equity therefore decline equally by $7.50. In your answer, state assumptions about tax rate, explain effects on EBIT, taxes, net income, cash flow, PP&E, and retained earnings, and distinguish the income effect from the cash effect. Question 10. How would you value a company with negative EBITDA? I would first understand why EBITDA is negative and whether the company has credible operating leverage. If losses reflect deliberate investment in a scalable business, revenue multiples, gross profit metrics, and a scenario-based DCF may be useful. I would examine customer retention, contribution margins, cash burn, and the path to profitability. Comparable transactions can provide context, but I would normalize for growth, market position, and capital intensity rather than applying a mechanical multiple. Focus on why EBITDA may be negative, distinguish temporary losses from structural weakness, use revenue multiples or DCF scenarios carefully, examine unit economics, and reference precedent transactions with comparable growth profiles. Question 11. What makes a good comparable company analysis? A strong comparable company analysis begins with businesses that resemble the subject company operationally, not merely companies in the same broad industry. I would compare end markets, growth, margins, scale, geography, capital intensity, and risk. Then I would calculate relevant enterprise value to revenue or EBITDA multiples, review ranges and medians, and investigate outliers. Finally, I would explain why the subject company deserves a premium or discount instead of treating the median as an automatic answer. Make sure to cover business similarity, end markets, growth, margins, size, geography, capital intensity, trading liquidity, selected multiples, and the need to explain outliers rather than blindly averaging them. Question 12. How does a precedent transactions analysis differ from trading comparables? Trading comparables reflect minority ownership prices for currently public companies. Precedent transactions reflect prices paid for control, often including expected synergies and a competitive sale process. As a result, precedent multiples are frequently higher, although timing, leverage, market conditions, and transaction-specific characteristics matter. I would normalize the data carefully, review the buyer's rationale, and avoid relying on an old or strategically unique transaction that is not truly comparable. In your answer, distinguish control premiums, synergies, market conditions, transaction timing, and data limitations, while explaining why precedent multiples are often higher than public trading multiples. Question 13. What are the main drivers of accretion or dilution in an acquisition? An acquisition is accretive when pro forma earnings per share increase and dilutive when they decrease. The main drivers are purchase price, target earnings, financing mix, interest expense, shares issued, taxes, and achievable synergies. Cash financing may create foregone interest income, while debt financing adds interest expense. Stock financing increases the share count. I would build a pro forma income statement, apply transaction assumptions, and test whether the result changes over time as synergies are realized. While answering, discuss purchase price, financing mix, buyer and target earnings, interest expense, foregone cash interest, synergies, new shares, taxes, and the timing of pro forma earnings impact. Question 14. Walk me through a typical sell-side M&A process. A sell-side process begins with understanding the client's objectives, preparing marketing materials, and identifying qualified buyers. The banker contacts selected parties under confidentiality agreements, distributes information, and gathers initial indications of interest. Shortlisted buyers receive deeper diligence access and meet management before submitting final bids. The client evaluates price, certainty, financing, strategic fit, and terms. The banker then supports negotiations, definitive documentation, and closing while maintaining momentum and protecting confidentiality throughout. Be sure to mention preparation, buyer identification, marketing materials, management presentations, indications of interest, diligence, final bids, negotiation, definitive documentation, and process management under confidentiality constraints. Question 15. What is a fairness opinion, and what does it not mean? A fairness opinion provides an independent financial assessment of whether transaction consideration is fair, from a financial point of view, to a specified group such as shareholders. The analysis may include comparable companies, precedent transactions, DCF valuation, premiums paid, and market perspectives. It does not guarantee the highest possible price, eliminate business risk, or replace the board's fiduciary judgment. Its purpose is to give directors a disciplined financial framework for evaluating the proposed transaction. In your answer, explain the opinion's role in assessing financial fairness, valuation methodologies, board fiduciary considerations, limitations, independence, and why it is not a guarantee that shareholders receive the highest possible price. Question 16. Tell me about a time you worked under significant pressure. During a group project, our team lost a contributor 3 days before the presentation. I divided the remaining work into essential and optional analyses, took ownership of the missing section, and created a shared checklist with interim deadlines. I also communicated early when an assumption needed to change. We delivered on time and received strong feedback for clarity. The experience taught me that pressure is manageable when priorities are explicit, work is reviewed early, and communication stays concise. Make sure to use a specific situation, explain the deadline and competing priorities, describe your prioritization and communication, quantify the outcome, and identify a lesson relevant to banking execution. Question 17. Describe a time you received difficult feedback. A manager once told me that my analysis was accurate but difficult to navigate because the main conclusion appeared too late. I initially focused on the amount of work completed, but I realized the feedback was about usefulness, not effort. I began leading with the answer, labeling assumptions clearly, and moving supporting detail into an appendix. Subsequent reviews became faster and more positive. I would bring that same responsiveness to comments from senior bankers. Focus on the feedback's substance, your initial reaction, the concrete behavioral change you made, evidence that performance improved, and how you would apply the lesson to analyst work. Question 18. How would you handle an error in a financial model shortly before a client deadline? I would first isolate the error and determine whether it affects outputs, presentation materials, or both. I would notify the associate or vice president immediately, explain the likely impact, and avoid quietly making an unsupported fix. Then I would correct the formula, trace key outputs, compare against prior versions, and have another team member review the change. I would document the cause and resolution, communicate the updated conclusion clearly, and build a quick check to prevent recurrence. Be sure to mention stopping the error's spread, quantifying the impact, informing the appropriate senior team member promptly, correcting and validating the model, documenting the issue, and preserving deadline discipline. Question 19. Why should William Blair hire you as an analyst? William Blair should hire me because I combine strong analytical fundamentals with dependable execution and genuine curiosity about businesses. I have demonstrated those qualities through finance coursework, detailed research projects, and team responsibilities where accuracy mattered under time pressure. I also communicate directly and respond well to feedback, which is important in a lean deal team. I understand the hours and attention to detail required, and I am motivated to earn responsibility by consistently producing work the team can trust. In your answer, present 3 evidence-backed strengths, connect them to modeling, research, communication, and teamwork, acknowledge the intensity of the role, and show a credible commitment to developing at the firm. Question 20. What questions would you ask your William Blair interviewers? I would ask how analysts are staffed across sectors and transaction types, and what distinguishes analysts who earn increasing responsibility. I would also ask how feedback is delivered during live processes, what training is most useful early on, and how junior bankers interact with senior decision-makers. Given William Blair's employee-owned structure, I would be interested in how that model affects collaboration, client relationships, and long-term development. Those questions would help me understand both the work and the culture. Make sure to ask thoughtful questions about analyst development, staffing, sector exposure, feedback, transaction responsibility, team culture, and how the firm's employee-owned model influences client service and career progression. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.